The financial markets today feel confusing for many investors. Inflation is no longer at crisis levels, but it is still influencing everyday prices. Interest rates remain high, yet discussions about future cuts are growing louder. Some days the stock market looks confident and optimistic, while other days fear returns quickly. In times like these, reacting emotionally can be costly. This is exactly why smart money behaves differently. Instead of chasing headlines, professional advisors and institutions quietly prepare for what lies ahead. Smart money always starts by understanding the bigger picture. Right now, the U.S. economy is going through a transition. Growth is slowing, inflation remains sticky, and central banks are trying to balance stability with control. Advisors are not expecting a dramatic economic collapse, but they are also not assuming a smooth return to the easy money era. Their strategies are built around uncertainty, recognizing that markets may stay uneven and volatile for longer than many expect. One of the biggest shifts happening is the move away from speculative growth toward quality investments. In the past, low interest rates allowed companies with weak profits to grow rapidly on borrowed money. That environment has changed. Smart money is now focused on companies with strong balance sheets, consistent earnings, and reliable cash flow. These businesses have pricing power, meaning they can raise prices without losing customers. In a higher rate world, stability and durability matter far more than hype. Fixed income has also returned to the spotlight. For years, bonds offered little value, causing many investors to ignore them completely. Today, higher yields have made bonds attractive again. Advisors are gradually adding short and medium-term bonds, U.S. Treasuries, and high-quality corporate debt to portfolios. This approach provides steady income while reducing overall risk. Instead of making aggressive bets on falling rates, smart money prefers flexibility and consistency. When it comes to inflation protection, smart money avoids extremes. Advisors are not blindly pouring money into one asset class. Instead, they selectively use commodities, energy, and infrastructure as protective layers within portfolios. These assets tend to perform better when inflation remains elevated, but they are not treated as long-term growth engines. Their role is protection, not speculation. This balanced use of inflation hedges helps reduce risk without overexposure. Real estate strategies have also evolved. Higher interest rates have made borrowing more expensive, forcing investors to be far more selective. Smart money is no longer chasing speculative real estate projects. Instead, advisors are focusing on properties that generate reliable cash flow and serve essential needs. Industrial buildings, data centers, and multifamily housing remain attractive because demand stays strong even during economic slowdowns. The focus has shifted from rapid appreciation to long-term income and resilience. One key advantage smart money has over retail investors is its approach to cash. Many individuals see cash as wasted opportunity, but advisors see it as a strategic asset. With money market yields offering competitive returns, cash is no longer idle. It provides income while preserving flexibility. Smart money keeps cash available to take advantage of market pullbacks, unexpected policy shifts, or sudden opportunities that others cannot access because they are fully invested. Global diversification is another area where smart money acts carefully. While the U.S. remains the core market, advisors are selectively looking at international opportunities. Some countries are at different stages of their economic cycles, which can reduce overall portfolio risk. However, this diversification is measured. Advisors pay close attention to currency risk, political stability, and policy direction. Global exposure is used to balance portfolios, not to chase uncertain returns. Instead of trying to predict exact inflation numbers or the timing of interest rate cuts, smart money focuses on long-term themes. Advisors are positioning around powerful trends such as artificial intelligence, digital infrastructure, healthcare innovation, energy transition, and cybersecurity. These themes are expected to grow over many years, regardless of short-term market fluctuations. By focusing on long-term change, smart money avoids the pressure of perfect timing. Another important lesson from smart money is patience. Professional investors understand that markets move in cycles. Short-term volatility is normal, especially during economic transitions. Instead of making emotional decisions, advisors rebalance portfolios slowly and strategically. They accept temporary pullbacks as part of the process and stay focused on long-term goals. This calm approach often separates successful investors from those who struggle. For everyday investors, the biggest takeaway is mindset. Smart money does not chase trends when markets rise, and it does not panic when prices fall. It plans ahead, diversifies risk, and stays disciplined. Decisions are based on strategy, not emotion. Over time, this consistency builds resilience and confidence, even during uncertain periods. Inflation and interest rate shifts do not automatically destroy wealth. What truly damages portfolios is poor positioning and emotional behavior. Right now, smart money is not betting on extreme outcomes. Instead, it is building balanced portfolios designed to perform across different economic scenarios. The next phase of the market is unlikely to reward speculation or fear. It will reward discipline, patience, and intelligent positioning. Those who learn to think like smart money understand that success is not about predicting every move. It is about preparing for many outcomes and staying committed to a long-term plan. In an environment shaped by inflation and changing interest rates, this approach may be the most powerful strategy of all.